Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee Distance Learning in Commerce. Today we are going to discuss another problem on insurance claim for loss of profit. I would like to request my viewers to subscribe my channel. I would like to request the students to write the question with the solution in your notebook. I would also request to browse the playlist section of the channel where I have uploaded lectures earlier. From the following particulars, prepare a claim for loss of profits under the consequential loss policy. Date of fire on 30th June 2021. Period of indemnity 6 months. Sum insured rupees 40,000. Turnover for the year ended 30th June 21 2 lakh. Net profit for the accounting year ending 31st March 21 12,500. Standing charges for the accounting year ending 31st March 21 28,500. Turnover for the year ending 31st March 21 1,98,000. Turnover for the indemnity period from 1st July 21 to 31st December 21 56,000. Turnover for the period from 1st July 20 to 31st December 20 1,10,000. The turnover of the year 21-22 had shown a tendency of increase of 10% over the turnover of the preceding year. This is a problem on insurance claim for loss of profit. To solve the problem, we have to follow the 4 steps. So step number 1 is to calculate the rate of gross profit for the previous financial year. To calculate the rate of gross profit for the previous financial year, we have to consider these 3 figures given in the question. So first of all, what is the net profit for the accounting year ending 31st March 21. So it is given as 12,500. So net profit for the accounting year or the financial year ending 31st March 21 is 12,500. With this figure, we have to add up insured standing charges. Now it is given in the question that only the standing charges, and it is assumed here that all the standing charges are insured. So insured standing charges for the accounting year ending 31st March 21. So the insured standing charges given in the question is 28,500. Sum total of these 2 figure, you will get 41,000. Now what is the turnover for the year ending 31st March 21? So the turnover for the year ending 31st March 21 is 1,98,000. So GP rate or the gross profit rate is 41,000 by 1,98,000. Multiply it with 100 and you will get 20.71%. So in step 1, the gross profit rate that you have to calculate is arrived at 20.71. And for this purpose, we have to consider the 3 figures. The net profit for the accounting year ending 31st March 21, and you have to add up with it the insured standing charges for the accounting year ending 31st March 21, which is 28,500. It is given in the question that the standing charges for the accounting year ending 31st March 21, 28,500, and we have assumed here that all the standing charges are insured. Now you have to consider the step 2. So in step 2, we have to find out what is the amount of short sales. So to calculate the amount of short sale, you have to consider what was the turnover for the previous year during the period of indemnity. So turnover for the period from 1st July 20 to 31st December 20. Please note this statement carefully. This is the turnover for the period from 1st July 20 to 31st December 20, which is given as 1,10,000. And there is an increase of trend. So there is an increase in trend of 10%. So you have to add up 10% of 1,10,000, which is 11,000. So 10% of 1,10,000, you will get 11,000. So it is expected that in this year, in the current financial year, your sales during this 6 months, that is from 1st July 21 to 31st December 21, it would have been 1,21,000. So this is the expected sales for the current year. But due to the fire, the turnover for the period from 1st July 21 to 31st December 21, that is the period of dislocation. When the fire took place, the normal business could not be carried out. So there was a dislocation of business and there is a fall in the value of sales. And the actual sales during this period happened to be 56,000. So what is the amount of short sale? Therefore, short sales is 65,000. So what we have done in step 2. So turnover for the previous year during the period of dislocation, that is from 1st July 20 to 31st December 20, which is given as 1,10,000. Now in this year there is a trend of increase as a 10%. So we have considered that the sales during the current year would have been increased by 10%, and the expected sales from the period 1st July 21 to 31st December 21 would have been 1,21,000, but the actual sales happened to be 56,000. So your amount of short sale is 65,000. Now in step 3, we have to consider what is the amount of gross claim. So amount of gross claim, and you have to apply the GP rate that we have calculated at 20.71% on the amount of short sale, that is 65,000, and the gross claim is 13,461. So 13,461 is the amount of gross claim that the company has to lodge with the insurance company. Now in step 4, we have to consider, or in step 4, we have to calculate what is the expected value of sum insured. So for the purpose of expected value of sum insured, we have to consider the turnover for the year ending 30th June 21. So the fire broke out on 1st July 21. What is the turnover for the year immediately preceding the date of fire? So this is 2 lakh. Turnover for the year ending 30th June 21 given as rupees 2 lakh. So this is the turnover, that is the turnover for the year preceding the date of fire. Now again we have to add up increase in trend at the rate of 10%. So this will be 20,000. So 10% of 2 lakh is 20,000. So this will be 2,20,000. Now what is the gross profit? Therefore gross profit 20.71% into 2,20,000. This is 45,562. So 45,562 is basically the expected value of sum insured. So in step 4, we have basically calculated first the expected value of sum insured. And for the purpose of calculating the expected value of sum insured, we have to consider the turnover for the year ended immediately preceding the date of fire, which happened to be 2 lakh rupees. With this figure, we have added the increase in trend, that is 10%, which is 2,20,000. And the gross profit on 2,20,000 turnover is 45,562, which is the expected value of sum insured. So actual sum insured, now this is the expected value of sum insured. You can write it here also. So expected value of sum insured. Now what is the actual value of sum insured? This is given as 40,000. Therefore, the net claim is equal to gross claim divided by the expected value of sum insured. Multiply this with actual value of sum insured. So the gross claim that we have calculated in step 3, this is subject to average clause. So in step 4, we have to apply this average clause and you have to calculate the net claim. So the net claim is equal to 13,461, which is the gross claim, divided by 45,562. This is the expected value of sum insured. Multiply it with 40,000, that is the actual value of sum insured, and you will get 11,818. So this is the amount of insurance claim that has to be lodged with the insurance company. Hope all the students have recorded the questions with solution and you have noticed the way I have solved the problem here. If you find any difficulty in understanding, feel free to communicate with me through email and the contact number given in the description box. Thank you. Thanks for watching the lecture.